I'm Mark Gagan and you're listening to the Voice of Insurance podcast, produced in association with Advantage Go, enabling an enterprise view of exposure. Today's episode is half of a duo of special podcasts released simultaneously that are looking to summarise the 1/1 reinsurance renewals. In previous years, I've compiled these interviews into a documentary-style episode to work as a précis. But this year, I enjoyed my interactions so much that I really didn't want to be chopping them up into clips. So I've produced 2 separate episodes instead of 1. Both my guests will be familiar to regular listeners, and they both bring very different, very complementary qualities. For a full picture of the renewal and the current state of the reinsurance market, I highly recommend you listen to both. This episode is with James Vickers, chairman of Gallagher Re International, who's been at the forefront of the reinsurance broking world for over 40 years. The other, episode 237, is with David Flandro, head of industry analysis and strategic advisor at Howden Re. With David, we examine all the broad macro factors washing across the reinsurance market and get a really great feeling for the big picture. But in this podcast, with James, we get into much more micro detail. This satisfying discussion examines the annual close encounter between clients' wants and needs and reinsurers' appetites, as well as their red lines. A listen will tell you that this market is not as black and white as a quick read of some of the simple headlines about declining prices will have you believe. There are many shades of grey, and an enormous amount of differentiation is happening between reinsurers and their customers. James is on exceptional form, and in this episode he doesn't duck any of my questions, and we don't leave any stones unturned. If you want to be really well informed, you need to talk to someone as personable and in the know as James. Come and join us. Gallagher Re has published its comprehensive 1/1 First View report entitled Differentiation Rewarded. Make sure you read it along with this episode. A link will be in the notes. Now it's time to get on with the show. Enjoy the podcast. James, really good to see you again. Another renewal has passed. What's your overall description of what happened at 1/1?
Well, Mark, I think that the lyrics in the run-up to 1/1 that we heard at Monte Carlo, at Baden-Baden and some of the other conferences didn't quite play out the way that some of the reinsurers might have hoped. Overall, was a calm and orderly renewal. Buyers were able to claw back a little bit of what they had given away in the last year or two, primarily because reinsurers were interested in growing. The reinsurers' capital base, particularly here, I mean the incumbents. Yes, there has been some new capital coming in the ILS. There was a tiny amount of new capital into the traditional reinsurance market, but the bulk of the capital growth has come from the retained earnings of the major reinsurers. And they clearly want to put that to good use. And what was noticeable this year, as compared to maybe 2023, where reinsurers were still well capitalized but were nervous about putting their capital to work. This year, they wanted to grow. They want to grow. They want to service this much larger capital base that they've got. And so they were looking for growth. Unfortunately for them, I think that the amount of growth was relatively limited. Cat limits went up a little bit on the property cat side. But what we're beginning to see is the unwinding of the high inflation impact that, particularly in the Western markets, in Europe and US, has helped to boost underlying growth. So that is a challenge for reinsurers. In somewhere like Asia, where there wasn't that inflationary growth is more difficult to come by. So against that background, the market did soften a little bit more in the last couple of weeks as reinsurers realized if they wanted to have a go at hitting their production targets for 2024, they needed to be a little bit more flexible.
So if we were sitting here as macroeconomists, which neither of us are, but just in very basic terms of supply and demand, the increase in supply slightly outstripped the increase in demand, and presumably there was a little increase in demand, but not as much as we've had before.
Exactly.
And so the natural result of that would be that pricing would come down a little.
Yes, it has. And, as we outlined in our report, we've called it differentiation rewarded, because this is not a market where it's easy to take a blanket comment across it and say rates came down overall X%. Rates did come down in some areas, and primarily areas where it was warranted, where results have been good, where the supply dynamic was perhaps overweighing a little bit on the demand side. But overall, it was a market that rewarded clients who could articulate their particular portfolio, their particular issues. Having said that, it was not a totally spineless market. There were examples of major reinsurers cutting their lines when they felt clients were pushing too hard, and in one or two cases actually coming off programs altogether. So this is not a blind, soft market. There is still considerable differentiation going on.
Yes, it's interesting about the differentiation. Do you think that's something that's changing? Is it just because technology that now some insurers have wonderful data that they can really make a case for themselves and they can really demonstrate a superior understanding of their own portfolio and they can articulate that to the reinsurer and prove it to them with facts and figures, they can get something reasonable?
Spot on. I think that...
Obviously, some can't do that.
No, they can't. But obviously, analytics is at the heart of it, and reinsurers want to grow, but they want to convince themselves that the risk they're taking is adequately priced. And the more data they can have to convince themselves that actually this 10% rate reduction or whatever the client is asking for is justified, and I, Mr. Reinsurer, is still going to write this business at a decent margin, they're happy to do that. However, of course, the reinsurers themselves are getting a lot more sophisticated in their pricing. So they are more demanding and they go into far greater detail. And certainly, in one of the difficult areas I think we'll probably talk about in a minute, the casualty side, that is absolutely at the core of it.
If you can demonstrate a really granular understanding of what you've been doing in your portfolio, you can show that.
Yeah, and it's not just what you've been doing in your portfolio, but how you go about it, your feedback loop on how you lessons learned from major claims, how your internal operations are set up, how efficient you are, all of that plays in. So it's very much, as you said, superior data, which allows far better analytics.
That's really interesting. So, because I would say in markets past, if we were sitting 20 years ago, you might have said, it's very difficult not to be all tarred with the same brush, isn't it? But do you think these days there's less of a reticence from a cedent's perspective to want to share that data with their insurer?
Kickstart your 2025 by attending Tintech London Market and supercharge your digital transformation and operational efficiency.
Tintech London Market allows you to explore the latest developments, innovations, and use cases for technology, Gen AI, and analytics in the London market.
And it's not just about the tech. It's about people, process, and technology.
You'll discover insights on developing successful change, building a high-performance culture, and successful implementation of emerging technology.
Join thought leaders and industry experts at the #1 technology strategy and innovation event for the London market.
Search Tintech London Market to discover the full agenda and speaker lineup.
I think that's exactly correct. I mean, 20 years ago, this data wasn't available. Even if it was available, the actuarial techniques, the computing power wasn't there to deal with some of these big data sets to try to turn it into something useful that a reinsurer could get their head round. But absolutely, and this is where brokers are playing an enormous role, because what we are articulating to our clients is if you want to get a better return, a better result from your reinsurance, this is what you've got to do. And frankly, we'll help you do it. I mean, there's an awful lot of work we do with our clients, helping them to prepare their data and look at it and test it. And
it is really interesting because it's certainly, I think, casting my mind back to Monte Carlo when we last spoke, and I was asking, what advice for your clients would be: really get prepared, be prepared. If you want to get something, you're going to have to prove your case, absolutely. And anyone who is better prepared will get a better result.
Agreed. As I said, it plays into what reinsurers want to see because, as I said, they want to grow, but they need comfort that the risk that they're taking is adequately priced. So the more data you give them, by and large, the more they can refine their pricing.
We've been talking a lot the last couple of years about the interplay between the change in appetite of reinsurers, favouring perhaps property one year and casualty more the next. Certainly, still the last doubts, as you've already alluded to, the last doubts at Monte Carlo this year would have been about casualty, more debate about casualty than about property. How did that play out?
I think there was that hiccup round about Monte Carlo in the end of Q3 with some of the US hurricanes when people thought that property would be back on the top of the list, but actually that all fizzled out and turned out to be a damn squib, and it's been a decent year for reinsurers on the property cat side. So yes, focus is back on casualty, and this is where reinsurers do have quite divergent views. But I think something that's quite often forgotten, Mark, is that you can look at certain classes of business, of casualty business, and then if you look at the top quartile underwriters, primary underwriters, and the bottom quartile, and the difference is stunning. I mean, in some cases, 70, 80 points difference. So teasing that out and giving reinsurers the confidence that your underwriting is producing this dramatically better portfolio is crucial. So we hear general comments on casualty. I think it's misleading, because within there, there's so many nuances on the front end underwriting and the management of the portfolio. And as a consequence, some reinsurers are relatively confident about expanding their casualty books. They have convinced themselves they've selected the right clients, they're writing the right business, they want to grow. Because if they can convince themselves that the pricing is adequate, it's an attractive class to grow in. Others sit on the sidelines and nervous that despite a lot of the changes that have gone on, they worry it's not enough. Social inflation, nuclear awards, these are coming down the line. And although it looks attractive now, what's the ultimate loss ratio going to be?
So in general, it sounds like it was a bit of a score draw. Not too dramatic. There was enough enthusiasm and appetite from some reinsurers to counterbalance the lack of enthusiasm and appetite from others.
Yes, I mean, there was adequate capacity. People got everything done they wanted done. So in that broad brush, not a problem. But that hides within it a huge amount of nuance.
Before we move on, I'd like to go back to that comment you made about Milton and Ellen. They were a damp squib. So yes, one of my questions would have been to ask, did it really affect the property cat renewals or property renewals at all?
No, it didn't.
Even as a reminder, obviously we're only talking about a few degrees north for one hurricane track, and it would have been an exponential difference in costs.
No, but you can always think of that. It can always happen. The fact is, it didn't happen. And so reinsurers for 2024, they'll all be closing within their Nat Cat budgets, some of them considerably within that. And they will have closed a profitable year. Job done. Yes, we've seen some of the rate reductions coming off, particularly on some of the top layers on the cat side. But again, you have to look at back over the last couple of years when particularly some of those US top layers were priced at there was a lack of capacity at that time. So giving up 15 points on these top layers is really not an issue for the reinsurers.
If something was incredibly remote and there was many, many multiples of what its theoretical probability of burning was.
No, agreed.
Yes, talking about that, attachment points, obviously, I'm sure 2 years ago, writing the top layer of anything would have been a very pleasant experience, and looking at theoretically, some of the most profitable bits of business that have probably ever been transacted for a very long time in our careers. If we were talking at any point in the last year, and obviously you spend so much time with your clients, their biggest gripe would have been, I know, reinsurance is here fundamentally to protect my capital, I understand that. But at other times, has also been here to help smooth out difficult, poor earnings events for me and help me out. And I'm looking for more of that partnership. I know it hasn't been available in the last couple of years because it's been a very hard market. But this is something I would like, in whatever degree you can get me, James. How successful has that been, that mission to try and bring in a little bit more earnings protection? Obviously, we know that ultimate retention levels have stayed pretty high. But within that, is there any of those reinsurers looking to really partner, looking to differentiate themselves, looking to help out? When I was at Monte Carlo, there was some message from some between the lines that they were looking to be a bit more friendly.
You've articulated it well there. A lot of buyers want a bit more volatility protection. They would love to have what they had 3 or 4 years ago, which is cat programs with very, very low retentions and straight-in aggregate covers. Those, by and large, are not available. However, if you split the low-level covers that are available, you've got those that are done on a structured basis. There is still a demand from buyers for that, and there's plenty of supply from reinsurers. They're very happy to write that. But of course, structured covers don't work for everybody. And what they would really like, as I said, the straight-in aggregate covers. Well, there was a little bit more being placed of those, very client-specific, where reinsurers felt that as part of a wider relationship, they could do that. And obviously heavily leveraged against placements on middle and upper
So
layers.
real trading. So I'll do this if you obviously don't sign me down anywhere else, etc.
That type of thing. But it was small. But as I said, you've got to be very careful to differentiate between structured and non-structured.
Again, so to summarise that, it would be a little bit more, but nothing like what it used to be. I suppose the complaint before was that the aggregates ended up with so many different secondary perils and they were being burnt all the time with all sorts of things that probably no one would have expected to end up in there. These days, presumably, they would be much more on a named perils basis, that kind of thing.
There's an element of that, yeah. What makes these covers very difficult is the frequency of small climate-related losses. We're seeing hail losses in countries that there was never any hail. And the first time, obviously, loads more flood losses, and it's those type of losses that hit the traditional aggregate covers. And, of course, that's what the buyers would like to have the protection for, and that's where the problem really still lies.
That's still the problem, and that's still going to be one of your fundamental problems to innovate your way around as a reinsurance broker.
I think there's an element of that, but also I think it's primary companies also having to underwrite their way around some of this. The reinsurers, in the decade up to probably 2021, 22, reinsurers were giving primary insurers a free pass on that. They were providing cover. Primary reinsurers really didn't have to concentrate very much on this.
Yes, I suppose now they've had a good couple of years of really having to think about it and retaining all of it.
And finding ways to mitigate and manage and underwrite around it.
I suppose that sounds like another way of differentiating yourself, doesn't it?
Absolutely.
So those that can demonstrate that they've really thought about this now and have attacked the problem
will stand better chances of getting some form of aggregate placements done in the years ahead.
Absolutely. That's really, really interesting. ILS had another very strong year. Has it been affecting the dynamics of the market at all?
In the main first-tier reinsurance, not very much. The pricing has been pretty disciplined. The ILS managers, if you look at the big funds who've attracted the most of the new money that's come in, they're pretty disciplined in what they do. It's had a little bit more impact in some of the peripheral areas, a little bit more retro. Obviously, there's been a decent amount of innovation around cyber bonds, but great for the cyber market, but actually, in terms of the market overall, not so big. I think the more interesting thing is the impact in the collateralized field, and a number of ILS investors showing signs of aligned themselves behind reinsurers with a decent franchise and a strong underwriting appetite. And that, again, I think also boosted the incumbent reinsurers' desire to write more premium at 1/1.
I wanted to just have a bit of a check-in on the excess levels which were all reset 2 years ago. So again, they really held up in real terms.
Yes, they did. And the lesson that reinsurers learned is how important the deductible levels are. They will trade price. There was a little bit of easing on some terms and conditions like prepaid reinstatements, slightly expanded hours clauses. All of that for a reinsurer is peripheral to the main issue of attachment point.
And they're comfortable that they're really in the right place, and
they're not going back. They're not going to give up.
It's not something you really want to disavow your clients of any hope that they will be going back.
No, I think you have to. This is where you have to come up with some separate innovation. You're back to we were talking about earlier, structured aggregate covers or lower covers, some sort of innovation. But the breadth of cover that was available prior to 2022, I think it's gone.
So looking forwards to April, June, July, etc., what's the outlook?
Well, I think it's more of the same. It's back to buyers who can articulate what they're doing in their front-end underwriting, the quality of their portfolios. Of course, it's a starting point where they're coming from, how many rate increases they've had. But I think what reinsurers are really going to be watching is what's going on in the primary market. And there are signs of rates coming off, particularly in some of the E&S property markets. And that has boosted that primary rate increase, whether it's driven by inflation or rating increases. That's lifted all boats, and that's beginning to run out. And that, I think, is what reinsurers will be closely watching. And in some areas, some of the more specialty lines like cyber, where primary companies were happy to place huge quota shares with reinsurers. And a couple of years ago, it was very challenging for brokers to place those because the premium volumes were large. Now, better analytics, better understanding, people's confidence is growing. Primary companies are beginning to retain a bit more and beginning to switch away from pro rata to look at more excess of loss solutions, which may be a better solution for them and may produce better margins ultimately for the reinsurers. But at the same time, it takes an awful lot of gross premium out of the market.
That's just, I suppose, the standard story of maturity of a new class, that it's a lot of proportion to start with. As you get more of a handle around what an event might look like and how to define it, you can start to go to excessive loss. And that's just the way, I suppose, insurance goes, isn't it? And its relationship with reinsurance.
I think that's right. That sums it up. I mean, again, it's interesting. If you look at something like the marine and energy renewals, there was no increase in demand at all. The only increase in demand is in the very specialised area of renewables, which again falls into that category. It's a new class of business. And some people would like to have quota share or some form of proportional reinsurance while they get themselves up to speed.
We've had some time now that inflation's fallen back down, a time of genuine real interest rates, and that's central banks, etc., and decent bond yields. You can get a genuine risk-free return. I mean, we're all happy now with cash savings accounts, which had previously not been earning anything, and now in the 3s, 4s and 5s. Very, very nice for all of us. Has that affected the psychology of reinsurers at all, in any sense? Obviously, 30 years ago, we could have sat here talking about the formula of, you could certainly write 103 combined ratio, but if you had a 3.5 to 1 reserves to capital ratio, whatever, you can end up with quite a good ROE.
Yeah.
Like, you could still run about 12 or 13% ROE.
No, I think
these days, obviously it's been such a long time since we could talk in those terms, but there has been a big boost when we're looking at reinsurance results. Obviously, retained profits has been one thing, but also there's been a lot of that profits come from investment income.
it has.
Has it changed mentality at all, or is it just will it take longer to sink in?
No, I think it does have a big impact because it has been a huge driver of profit for reinsurers. And it is important, therefore, premium growth, new premium that you can invest at these more attractive rates is very attractive to have. However, I think the days you were talking about, the sort of basically cash flow under, I think those days are over. I think
that message would never go as far. The CFO might be happy and the finance department's happy, but they're not telling the underwriters.
No. They're still saying, got to hit your numbers, ideally sub 90% combined ratios, and then you put the two together and you've got something really quite attractive.
And I suppose the proof of the pudding is, where are the underwriters' bonus targets set?
Yes, and then, and if they're quoted companies and it's set on the overall results, yes, of course it matters. But of course, the other thing to remember, Mark, is that most non-life reinsurers, their investment horizon is maybe 3 or 4 years. So they've still got reserves and investments that they were making 4 years ago that are now coming off. They're able to reinvest those, so that the impact of the better investment returns is going to last for several years. It's not like the underwriting, which will fall off more quickly.
Yes, it's there. It's money in the bank, literally, isn't it? So it will be generating compound interest.
And there are some of the very sophisticated reinsurers who see that finding ways to generate additional returns on the investment side with a very low risk is in fact potentially the new frontier, particularly for long tail classes of business where investment income plays a much greater role. And we are seeing everybody's very interested in how to get a better return, innovative ways of doing things.
And I suppose that might bode well for the legacy market as well, because, again, we traditionally have a less of a regulatory focus on their investments,
yes.
So therefore they can get better returns.
That's the theory, yeah.
And therefore be right. Competitive when they're looking to take away liabilities from the traditional market.
Yes, and also their investors, their shareholders, will be expecting them to produce a superior return. They will be looking, the returns for some of the legacy reinsurers have not been particularly good. They will be wanting to see now's the time to actually, you can make us some money.
I suppose one thing we always talk about, or very often talk about over the last 20 years, have been this idea of partnership. And I think it was certainly coming to the fore a bit more at Monte Carlo, particularly from the reinsurers wanted to say, look, I'm really looking to extend my partnership with my top people and to find new good partners. That's why I'm here. 30, 40 years ago, sometimes that never felt that genuine. But I don't know about you, but I want to propose that it does feel much more genuine. We're talking about genuine differentiation, that must mean genuine partnership, isn't it? Once you've made your choice, you say, I think this cedent A is better than cedent B, and I really like them. I want to support them in everything. And I want to actually have a more of a cross-class relationship with them, etc. Do you think that's it's something that's really coming true?
I think it is. Because, go back to what we were talking about earlier, there's much more data coming. There's much more analytics around. But that requires an investment in time by the reinsurer. So why am I going to spend time really looking at this particular company's portfolio? So that is something that is coming closer together. The problem with that is that whilst it's a very attractive trend, it does occasionally go wrong. And therefore, when it goes wrong, the consequences of a disagreement can be rather more profound than they were historically.
All partnerships, if they come to an end and they end badly, they can end
be
very badly because there might be emotions and lots of investment.
All sorts of things can go wrong. But yes, I think that is true. And whilst for the 23 and 24 renewals, buyers who thought they had built close relationships with the reinsurers, they were not particularly happy and felt that they were being tarred with the same brush. And, well, what's the point in making a big effort with the reinsurer and saying you're my long-term partner? I hear you, but you're not actually acting.
But you weren't there when I really needed you, yeah.
They are now beginning to act. And so for those buyers who have made the effort, I think they're now beginning to think, actually, no, it was a worthwhile exercise and I do need to keep doing this.
We'll see more buyers, still see the buyers at Monte Carlo as perhaps they, over the preceding soft market, they tended not to bother coming because they didn't need to. Well, some of them hadn't. You know what I mean? They were less around.
Or to be honest, a lot of the real relationship work is not done at those conferences. Mm-hmm. It's actually done meetings in the offices, day-long meeting, actually sit down, really get into the nitty-gritty, which in a conference meeting, you're not going to be able to have that sort of detail, work out what other areas you want to look at and work together. So we'll wait and see whether conferences, well, they'll always have their place.
There's one thing I remember now that I'm sitting with you. It wasn't my list of questions, actually, but it was something you're the first person to have mentioned this a couple of years ago, was the property per risk. Mm-hmm. And I think it's in your report. Again, that seems like that was a market that was having a lot of difficulty, but now looks like slightly stabilising, but still not quite there.
No. And the problem, I think, is one of original underwriting, that terms and conditions, pricing, the complexity of the original risks, the original risk management, the impact of inflation is not being properly reflected in the approach that commercial property underwriters are able to take. And it feeds through into the risk excess of loss market. And sadly, it's sort of pretty much universal. You can't pinpoint any one market and say it's worse than the other. I mean, in our report we mentioned, it's quite interesting if you look at the Scandinavian market, it's got so difficult there. That market was dominated by 4 large local/regional insurers. 2 of them have given up writing commercial property. The other 2 have scaled back. So the buyers in Scandinavia are now having to access offshore markets, primarily the rest of Europe and Lloyd's, and will we wait and see how that ends? Whether they will do a better job of underwriting it.
So it's about original underwriting. Yes, and property risk is quite interesting because obviously it's non-proportional, but then it seemed a bit like pro rata in some way because it does tend to depend upon the original rating and original underwriting.
Well, the truth is, I think a lot of buyers would like an old-fashioned property surplus treaty where they could share it, but of course the treaties are largely unplaceable, so that they're in many markets, so they fall back on excess of loss, but of course they're still bearing the retention.
It's down to the original underwriting to improve.
And the original risk management. I think we hear stories the whole time of surveys being carried out and then the original policyholder not implementing whatever the survey recommendations were. It's good old-fashioned stuff, but at the same time, you've got the complexity of the cost of rebuild, complexity around BI. Everything is much more complicated, automated machinery that costs millions to get hold of and repair, or a bit of smoke damage and it's written off. So it's it's an important subsector. The other one to remember is that most reinsurers don't carry much retrocession on their property per risk books, so they're writing net lines, so the capacity is much smaller.
So it's much more painful when it's not working.
Yep.
So again, it's down to original results.
Yep.
When they start to improve, then capacity is more likely to become available.
And what you'll see is it will improve spottily around the world. One market, they will eventually, they've had enough and they'll introduce changes. pro rata and more reinsurance will come in that market. But then equally there'll be other markets where nothing has happened yet or it's still insufficient.
What else do you think we should be talking about? Was there anything else you found interesting that's not on my list of questions?
What was interesting was that we talked earlier about the supply-demand dynamic. Specialty lines has been seen to be very popular by reinsurers, and there was very little increased demand and an absolute wall of capacity of people wanting to write it. And interestingly, I think because you've got a couple of big losses still sitting out there, the Baltimore Bridge loss and the final resolution of the Ukraine-Russia aviation war losses, those will come to a head in 2025, that perhaps buyers were more mindful of those big claims coming through than perhaps with the wall of new capacity coming after them. They were, if they didn't have those claims, they might have been prepared to be more aggressive. But now is not a good time to have a big row with your leader when you know in the next 12 months you're going to be asking for a big claim to be settled. And certainly in the case of the Ukraine one, a very, very complicated claim.
It's quite an interesting volatility around the appetite, because obviously as soon as the Ukraine war started, there was a huge shock, a supply shock. And now it seems to be that's all over and not a problem, and back to being a great diversifier and something that's historically made plenty of money.
Yeah, people actually haven't had to pay the claim yet either.
Yes.
So we'll wait and see.
It's very interesting, yes, is that the cash hasn't come out of anyone's account.
Well, a little bit has, but not the main numbers. And of course, that loss was probably not going to fall evenly in the market, so there's something else to think about. Cyber was interesting. Last year, the whole number one topic was cyber war. That's now calmed down. I think that the primary underwriting is tightening up in that regard, and reinsurers have become comfortable with what's going on. As I mentioned earlier, there's a growing confidence in understanding tail risks. There's been a lot of work done, a lot of publications. Interesting, it's not often a broker, a primary insurer and a reinsurer all get together to issue a report. There's us, Beazley and Munich Re.
Yeah.
Primarily to help give confidence to the market around this tail risk issue, which that, to be fair, seems to be working. People are becoming a little bit more comfortable in that space. And then the other one was PVT, political violence and terrorism, where war on land is still a tricky subject. What was interesting, because there was quite a lot of talk about it before, but actually reinsurers have been quite reasonable in just asking for information, is around SRCC.
Yeah.
Nobody was looking to...
Yes, there was a build-up from... Yes, there's a potential terms and conditions conflict.
Well, I think there have been... I mean, one of the problems with SRCC is that surprise losses came, and the one that took everybody by surprise was the one in New Caledonia, which hit the French market particularly hard in a place that most people probably didn't know where it was on the map. And then you look at the loss and think, oh my goodness me, that is a big claim. So that, I think, is something you'll develop.
It's more of a question around a renewal. Well, can you tell me what your SRCC exposures are, please?
I think there's signs there that problem will be managed on a partnership basis, with primary companies giving more information about what they're doing, how they're trying to control things. And then that'll give reinsurers confidence.
Excellent. Well, James, thanks so much for another really enjoyable discussion, and have a very good 2025. And I'll be catching up with you later on in the year.
Mark, thanks very much.
Thank you.
Great to speak to you as ever.
Well, I hope you enjoyed today's episode. If you did, don't forget to subscribe or leave a like or a review or recommendation on whatever podcast platform you used to access this programme. These really help get the word out. Before we go, just a quick reminder that advertising slots are available here and in other places in the Voice of Insurance podcasts. Podcasting is the fastest growing medium and attracts a high quality audience of key decision makers. It's also an intimate medium where you, the listener, are right in the room with me and the interview subjects. Needless to say, that means it's a great way of getting your message out directly to an audience, because you know you've got their full attention. It's also very cost effective. So get in touch with Mark at thevoiceofinsurance.com to find out how you could be speaking directly to the industry. The Voice of Insurance is produced in association with Advantage Go. Release your underwriters to underwrite with Advantage Go's underwriting platform. Voice of Insurance is produced by me, Mark Gagan. Music was written by Anna Gagan and produced by Carlos Gagan. Check out more podcasts and written comment pieces at www.thevoiceofinsurance.com.